Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Well, good afternoon, everybody, and welcome to another episode of Reynolds Wrap. Joining me today, of course, my good friend and business partner, Cory Stilp.
Hello, everyone.
So today we're going to talk about volatility. And, you've heard us talk about sequence of return risk in the past. We're big proponents of that in retirement, especially about educating people about how that can affect you long term. And so today we've got some information that we think is pretty powerful that speaks very highly to that. And what we're going to do is we're going to compare using the S&P index from 1999 through 2019, and then we're going to compare those numbers with the U.S. aggregate bond fund over that same period of time. And I think this is going to probably, a lot of people might not think it's real, actually, because when I first looked at it, I was kind of shocked myself. But these are real returns over that period of time. And I think it's going to amaze a lot of people what the end result is. So,
yeah, I agree. Great subject today, and glad you're listening in. When it comes to the distribution phase, I guess that's the key to looking at and comparing these two indexes or funds, if you will, is when you are in that distribution phase and you're taking money off of that asset. That's when the volatility in the market can greatly affect the dollars that you have at the end of any given cycle. In our example today, 1999 through 2019. So if you want to go ahead and start them off, Don, with kind of the $1 million and the RMDs are taken and what it looks like in the S&P, and we'll go to the U.S. aggregate bond fund.
All right, sounds great. So what we did is we started with $1 million, and of course, it doesn't matter what value you have. The numbers will all speak loudly to what the end game is or the end result. So, and then what we did is we said they started taking $40,000 a year from that account. And then, of course, we have that thing called inflation. We've talked plenty about that in the past. And so we're increasing that $40,000, 3%. And so what happens is each year, whatever the S&P does, your account value is going to go up. And if it's a negative, it'll go down. And so the end game is after the 20 years, the average rate of the S&P was 6.48% per year. And at the end of the 20 years, there was $148,060 left of that $1 million balance. And of course, your income has increased to $72,000 by 2019. So, obviously you're getting more income, but I don't know many people who want to be 20 years into retirement and have less than half, or in this case, just, about 15% of the original principal they started with.
Yeah, and if you're taking out $72,000 at that point, and if it is an RMD, which is a required minimum distribution, you can't stop. You have to continue to take those each and every year, or face a high tax penalty. It might only last another 2.5 years at this point, and the $1 million goes to a zero balance. Now, comparing the same situation, $1 million, again, starting at $40,000 in 1999, raising it 3% all the way through 2019. But using the U.S. aggregate bond fund as just a benchmark to compare to the S&P. Of course, there are many other options out there that will give you more stability and take this volatility out that we're talking about. But that same time frame and that same $1 million taking out the same distributions each and every year, raising it 3%, the average rate of return during that time frame for the U.S. aggregate bond fund is 5.04. Now, you would probably think because it's lower than the S&P that the ending dollars or value in that account would be a lot less. Well, here's the kicker. Because the volatility was taken out and we didn't have those low peaks and high valleys that we experienced with the S&P during our distribution phase, you actually have an ending account balance, $943,438. So you barely scratched into that $1 million because the volatility was taken out. And that's the real key component that we want our listeners to understand today.
Absolutely. We've talked about in the past, if you lose 50% of an account value, you got to make 100% back just to get back to zero. Well, that's really what we're talking about here. And then what magnifies that is when you are drawing off the asset. And we've talked about this many times in the past. it really can devastate the long-term effects of that account.
Yep.
So what we're really saying is does it benefit, in retirement to chase those high retirement or high returns while you're taking distributions? Or is it better to maybe just reduce that and go with some more fixed? And today with the higher interest rates, you can get 5% today out there. There's no question about that. And I'm not saying that's the greatest return, but again, we're talking about your retirement plan. And we're trying to make a point here that you don't need to be chasing high returns, and you can still be just fine with your averaging 5% over 20 years. And, like it said, and we're happy to share this information for any of the listeners who would like to see it. Again, we don't just talk the talk, we actually back it up with factual data. And like I said, I was even surprised when I saw this myself, but the numbers are real. And so, again, we're just trying to stress to people they have to understand sequence of return risk. They need to understand what volatility can do in retirement, how it can negatively affect you long term.
Yeah, absolutely. So please give us a call at 651-773-3859. Again, 651-773-3859. We'd be happy to have you in. We can share this report with you. You can look at the black and white logical data right in front of you to see, again, how this works. And year by year, of course, we summarized 1999 to 2019, but we'll show you year by year what's going on and line by line and how the end results are drastically different. So again, you want to seek some options. You want to look at some things because when it comes to retirement, when in retirement would you feel like living on half of your assets? 10 years in, 20 years in, where and when would you say, I'm pretty concerned now for the rest of my retirement, whether it be another 15 or 10 or 20 or 25 years, having a situation like this where it's drastically different just over that time frame. So
absolutely. So with that, we want to thank you for your time today. We hope you're getting some value out of our podcasts, the videos, if you're watching them. Any feedback, we'd love it, good or bad. We can always get it better, and we know that. So, but again, with that, if you have any questions or you'd like to set up that what we call discovery meeting with us, again, it's no cost, no obligation. Yes. We're happy to do that for you. Again, you can call 651-773-3859. Again, that's 651-773-3859. Thanks very much, folks. Have a great afternoon.
Thank you, everyone.
Listen to more with Don Reynolds and Cory Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.